Hey everyone, Ghost here, and welcome to Trading Basics. Today I want to go over kind of an important issue, and that's basically how market makers move the markets and liquidity. Basically, all liquidity is areas in the market where there's basically money, which consists of either stop losses, um, liquidations, such things like that. And the market uses the liquidity to to basically move the market in either an up direction or a down direction. And understanding liquidity, where liquidity is, and how the markets move really gives you a key insight into where the market makers are planning on taking the market, as well as let you look into areas of probability of where the market could come to and then reverse from. So let's just take a quick look here. This is on the 1-day Bitcoin chart, and I mapped out here the areas of where retail traders most likely have their stops. If people shorted the top, they're told to put their stop loss above the last swing high. People shorted this move up, you got stop losses here, and you have the longs that took longs here. They put their stops below these swing lows. Um, so basically, if you look at this chart, we know we have area of liquidity here, and we also have areas of liquidity here. And generally what happens is, the market moves up, moves down, moves up, and we'll go into a lower time frame to look at this. And what they'll do is they'll come down, push the price down by basically stop loss hunting, and then from there, uh, price will generally reverse at some point once they've liquidated and taken all their money. Now, one of the basic reasons is if, say, a big player, say you wanted to get 50 Bitcoin filled, you're not going to place a market order, or you're not going to, um, you know, just buy at once. What you're going to do is, put your limit orders in areas where people are going to be basically liquidated or forced to sell. So if you're looking to buy, say, over here for a push up, and below these two lows right here that there's stop losses, what you're going to do as a big money player is wait for the market to come down, liquidate these stops, which triggers a limit sell, and it's going to sell right into your order. So your order gets filled, and then the market moves back to a different direction. Now, if we go down onto Bitcoin into a 4-hour chart, what we're going to see is, we have stops above this high here. Right now, we have stops above the high here, and below here we have two areas of lows where people put their stop losses. So what the most likely scenario here is the market's going to move up. They'll take out these stops. Now, if they want to move lower at this point, what's going to happen is you're going to get a bunch of people then that are going to put their stop losses below this low, and now the market has the liquidity, or the basically the fuel, the money, to push up, get more stop losses in this area, and then drive the price down, not only through those stops, but trigger a little cascading effect here, or an impulse, that's going to drive the price down into waiting orders, possibly here. The other thing that they can do here, if they want, and they really want to drive price lower, is they can just not put orders here, look to buy in this area, which would be here, below these stop losses, and then when price moves up, liquidates, drives down, then all their orders will be filled down here, and then price, it will be set to move up. So basically when you're looking at liquidity, it's just basically as a retail trader, where you're going to put your stop loss when you enter a trade. If you look up here, one of the reasons why, we have an impulse coming off the high up here is, at this point, when you look right in this area, we have liquidity here, liquidity here. So when they drive the price down, you're triggering stop loss effects all within this area. What that does is cause this impulse down. You have a little consolidation, and as price is moving up, it's building what? Stop losses here. So boom, it takes it down again. You get the same scenario, stop losses. Now you impulse down, you take them, but you're also taking all these stops along here. Ultimately, then what's going to happen is we're going to get down to an area where we have no more stop losses. So then what's the market going to do? It's going to create more by, let's just say the market comes down, right? It creates stop losses here and here. It'll go down, come up, come up. And now what it's done is created liquidity here and here. So now it has the fuel to push the market back lower. And that's just the basics on liquidity and how the market moves up and down. And, my next video, I'll go into a little bit more in depth on how we can look at this and kind of judge where the market's going to go. If you like this content, hit like, subscribe, leave a comment on what you'd like to see more discussed in the channel. And have a good day, everybody.